Hello, everyone, and welcome back to the podcast, where we dive deep into the fascinating world of history, economics, and everything in between. Today, we're embarking on a journey through the annals of American monetary history, with a book that has been hailed as a seminal work in the field, A History of Money and Banking in the United States, the Colonial Era to World War II, by the legendary economist Murray N. Rothbard. Our story begins in the Colonial Era, where the American colonies were bustling with economic activity but lacked a standardized currency. Instead, they relied on a hodgepodge of commodity money like beaver fur, tobacco, and even wampum. But as trade with Europe grew, gold and silver coins, particularly the Spanish silver dollar, became the dominant form of currency. However, the lack of a central mint meant that foreign coins, including Spanish, French, and Portuguese, circulated freely, creating a diverse and somewhat chaotic monetary landscape. Enter the colonial governments who, in their infinite wisdom, decided to solve the perceived shortage of money by issuing their own paper money. Massachusetts led the charge in 1690, printing paper notes to pay soldiers after a failed expedition against Quebec. This marked the world's first government-issued fiat paper money, and it set off a chain reaction. The notes were initially promised to be redeemed in gold or silver, but as you might expect, that promise was quickly broken. The result? Rapid depreciation, inflation, and the eventual disappearance of specie from circulation. This pattern repeated itself across the colonies, with each new paper money issue leading to temporary economic booms followed by busts. The British government eventually stepped in, banning further paper money issues and forcing the colonies to return to a specie-based system. But the damage was done. The colonial experience with paper money had sown the seeds of distrust in fiat currency that would persist for centuries. Fast forward to the Revolutionary War, and the newly formed Continental Congress faced a similar dilemma. To finance the war, they turned to issuing the infamous Continental currency. Initially, these notes were backed by the promise of future tax revenues, but as the war dragged on and expenses mounted, the printing presses ran wild. The result? Hyperinflation and the near worthlessness of the continental dollar gave rise to the phrase, "not worth a continental." The post-war period saw a brief return to a more stable, specie-based system, but the temptation to inflate the money supply proved too strong. The Bank of North America, the first central bank in the U.S., was established in 1781, but it quickly lost its central banking role and became a private commercial bank. The dream of a central bank, however, was far from dead. Enter Alexander Hamilton, the architect of the American financial system. Hamilton, a staunch proponent of a strong central government and a centralized banking system, pushed for the establishment of the first Bank of the United States in 1791. Modeled after the Bank of England, the first bank was a private institution with a federal charter, and it played a crucial role in stabilizing the nation's finances after the war. However, its inflationary policies and the concentration of power it represented sparked fierce opposition from the Jeffersonian Democrats. The battle over central banking raged on, culminating in the demise of the first bank in 1811 and the subsequent financial chaos that ensued. The War of 1812 further exacerbated the situation, leading to a suspension of specie payments and the proliferation of state-chartered banks issuing their own paper money. The result was a chaotic monetary system with varying rates of depreciation and a lack of confidence in the banking system. In 1816, the Second Bank of the United States was established, but it too faced opposition and was eventually dismantled in 1836. The period that followed, known as the Free Banking Era, was anything but free. While entry into banking was more open, the system was plagued by periodic suspensions of specie payments, wildcat banks, and a lack of uniformity in banknotes. Rothbard's analysis of this era is particularly illuminating. He argues that the so-called free banking system was heavily influenced by government regulations and the requirement for banks to hold state government bonds as reserves. This tied the expansion of bank credit to the public debt, creating a system that was inherently inflationary and prone to instability. The mid-19th century saw the rise of the Jacksonian movement, which advocated for hard money and the elimination of fractional reserve banking. Andrew Jackson's war on the Second Bank of the United States and his subsequent establishment of the independent Treasury system marked a significant shift toward a more decentralized and hard money-oriented monetary system. However, the legacy of the National Banking Acts of 1863 to 1864, which created a quasi-centralized national banking system, continued to shape the American monetary landscape. Rothbard's exploration of the national banking system is a masterclass in economic history. He meticulously details how the system, while promoting a degree of uniformity, also centralized reserves and tied the expansion of bank credit to the purchase of government bonds. This created a system that was inherently inflationary and vulnerable to financial panics, as evidenced by the panics of 1873, 1893, and 1907. The late 19th and early 20th centuries were marked by growing calls for banking reform and the establishment of a central bank. Rothbard delves into the machinations of the financial elites, particularly the Morgans and the Rockefellers, who were instrumental in the push for a central bank. He argues that the Federal Reserve System, established in 1914, was not a response to the needs of the people, but rather a carefully orchestrated plan by powerful financial interests to consolidate their control over the nation's money supply. Rothbard's analysis of the Federal Reserve's early years is both enlightening and disturbing. He reveals how the Fed, far from being a neutral arbiter, was deeply influenced by the interests of the large Wall Street banks. The policies it pursued, particularly under the leadership of Benjamin Strong, were geared toward supporting the British return to the gold standard and maintaining the gold exchange standard, which ultimately contributed to the economic instability of the 1920s and the Great Depression. Rothbard's work is not just a historical account. It's a powerful critique of the prevailing economic orthodoxy. He challenges the conventional wisdom that the gold standard was inherently deflationary and that the Federal Reserve was necessary to stabilize the economy. Instead, he argues that the gold standard, when properly implemented, provided a stable and sound monetary base, and that the Federal Reserve, far from being a solution, was a major part of the problem. In conclusion, A History of Money and Banking in the United States is a must-read for anyone interested in understanding the complex interplay of politics, economics, and power that has shaped America's monetary history. Rothbard's insightful analysis and compelling narrative provide a fresh perspective on the forces that have driven the evolution of the American monetary system. Thank you for tuning in to BrightLearn. If you enjoyed this episode, be sure to subscribe and leave us a review. Join us next time as we continue to explore the fascinating stories that shape our world. Until then, keep learning, keep questioning, and keep shining bright.
Visit brightlearn.ai for more fascinating videos like this one, and naturalnews.com for full editorial coverage and breaking news on critical stories that keep you informed and aware of what's really going on.